Alright, so we should all know by now my favorite series on the channel besides the portfolio updates that I do to my portfolio every month is of course the subscriber portfolio review series where I go over subscribers, other content creators, and so much more in the finance space. It's a great way not only to promote transparency amongst the community, which is lacking a lot, but also open our eyes to new investing strategies, different stocks, and so much more. And today I have the pleasure of going over Nick's portfolio from Dividend Growth Income. He has a channel with about 22,000 subscribers, and I'd highly recommend you go check it out if you're looking for real man's investing quality content. Also, we're going to be hosting him on the Cashflow Kings live channel this Saturday. We're going to be asking him all the good questions, talking about certain scams in the finance community from dividend talks and so much more. So be there and be square. Thank you, and of course, roll the intro.
Hello, I like money.
So if you're new here, before I go over the portfolio, I like to know the investor's situation, their goals with the portfolio, and so much more. Because what my goals and what my investing objectives might be like might look different from yours or theirs. So his goal with his portfolio specifically is to get it to $1,000 in monthly dividend income, but by investing in quality businesses and focusing more on dividend growth than dividend yield. I personally think this is the way to go on a long-term time horizon. He's looking at a 7 to 10 year time frame to get it to there, but we have to see based on how much he can contribute. So first and foremost, I think this is the right way to go over dividend yield investing. I will say though, a 7 to 10 year time horizon, it is doable, but I think long-term time horizon like 10, 20, 30, 40 years is really going to reap the rewards of dividend growth investing. So I will say this, maybe it would be right to maybe add some yield into the portfolio if you're looking at a 7 to 10 year time frame to get there. But with that said, I still do think that having dividend growth options in the portfolio is definitely going to be the way to go. I'd probably look for a ratio of 60 to 70% dividend growth options and then maybe the rest in yield. And when I say yield, I don't mean like the Yield Max or JEPI ETFs or whatever. I'm not talking about like actual businesses that have high quality yields. He also put together this amazing spreadsheet here, which is available if you watch his channels and videos. This is a great way to really, track your portfolio, and that's something that I eventually want to get into. We'd see right now his portfolio has a market value of $18,933.09. Out of that, $17,600 of that is invested. Currently, his portfolio yield is sitting at 3.12%, which I think is pretty solid if you're looking for like more dividend yield and growth. Obviously, 7 to 10 years, he's going to be looking for some yield as well. I think that 2 to 4% range is acceptable in this case. His portfolio yield on cost is already 3.35%, which is very solid actually in the short term. Currently, he has $350 in dividends being collected. In 2023, he collected $337 in dividend income, and from 2022, that he only collected $12.81 in dividend income. We could see how much the contributions and really just short-term effects of compound interest have really been working for him, and that's just awesome growth to see year over year. And if it continues, I can only imagine where it could be. Currently on his portfolio, he has an unrealized gain of $1,300, which is 7.38%, which is solid, and he has a true gain of 9.12%. And Nick is just like me in that his biggest dividend months are going to be the March, June, September, December months. I always know when I'm looking at that chart that those months are definitely the December months, so that's awesome to see. But overall, very positive to see here, and let's get into the holdings and the bread and butter. Currently, we can see in his portfolio he has 27 separate holdings. Now, me personally, you guys would know at this point in my investing journey, I'm definitely more in a consolidating phase. So I personally, when it comes to holdings, I like when it comes to like 1 to 15. I think that's really the optimal range. I think like that 10 to 20 range is really solid for most people. So I think there are a few positions that he definitely mentioned as well that he's going to be looking to sell out of eventually. I always talk about the over-diversification trap, or as Charlie Munger refers to it as, is diversification, which is essentially just buying stocks to buy new companies and not really buying them for the quality. It may be an okay quality company, but you're mainly buying it for diversification in one sector or business. I think that's the wrong way to go overall, and it's a trap that a lot of new investors who are really optimistic and excited about investing really fall into. And I could probably see where that could have been the case for him. It was the case for me. It's the case for a lot of new people who get introduced in dividend investing. Over-diversification can lead to underperformance in the short term and leave you in a pit hole of a lot of stocks and a lot of red at times. That's how it was for me, but I'm definitely out of that pit hole and looking behind it now, thankfully. But at the same time, he is investing for dividend income, so you are going to want some diversity there when it comes to like your income streams. But at the same time, do not be sacrificing quality for that. This is definitely not the worst case of diversification, though. I actually think it's just like 5 or 6 stocks that he could probably sell out of and he'd be just fine. Alright, starting in his largest holding, it is VYM, which is Vanguard's high yield dividend ETF. Now, his next holding is SCHD, which is another high dividend yield ETF, and I immediately have a bit of an issue. Both of these make up about 9% of his portfolio, but they are kind of the same thing when you look at it at the end of the day. I would personally research into both of them, compare their data, look at their long-term forecasts, the portfolio rebalances that are coming up in March, and find the one that you think is going to be best for you. I would go 10 to 15% into that and take the other 5%, or maybe you can even buy like SCHG or growth ETF. I know you obviously are looking for dividend income, but me personally, I would rather put all of that money into SCHD. They are both basically the same exact thing, just with different logos and brands. So that's my first thing that I would personally do with it. I think that it's very solid. Also, his third largest holding, which I'm very happy about, is VU, and you cannot go wrong with that whatsoever. So I would actually suggest probably selling out of VYM and putting it in SCHD, or vice versa, whatever you see fit. I would actually recommend making VU 10% of the portfolio as well. Next, he has Chevron, and Chevron is an oil giant. It's not going anywhere, that's for sure, and I think it is a better high-yield option for him in the portfolio. Right now, on his Chevron position, he is down a little bit, but I would recommend loading up, especially if there's like another oil crash like 2020. That's something that I definitely learned that I'm going to be doing. If there is another oil crash like that, oil is always going to come back. We're not going to all EV anytime soon. I think that's a bunch of buffoonery. Next, he is Vici, and I love Vici so much. Vici makes up around 4% of his portfolio and is one of the core holdings. Vici is such a strong business at the end of the day, and every day that passes by, it seems like I'm buying a new Vici share. I'm expecting my next Vici dividend to be absolutely massive, and this month I got a pretty big one. So I'm really excited about the future of Vici, and they've also been investing into some new properties around baseball complexes. Next, he has NextEra Energy, and NextEra Energy is a really weird company that I actually hold as well. See, I bought NextEra Energy for kind of the diversification trap, but also they're a high growth dividend utility company, which is not a common thing. Now, NextEra Energy is heavily involved in the clean energy movement. That was my bull case, except when I bought, I had no idea anything about clean energy. I just knew that it would probably work out in the long term. NextEra Energy is one of the biggest losers in my portfolio as a result of that and stepping out of my circle of competency. With that said though, they do have strong dividend growth, but there's been a lot of questions around the sustainability of that and the insane debt that they carry. NextEra Energy is the most unstable utility company that is supposed to be a staple. Currently with my NextEra Energy, the biggest lesson that I learned was stepping out of your circle of competency. Don't do it. Just buy stuff that you really do understand. Don't buy a utility because it's a utility. With that said though, NextEra Energy could be a solid recovery play, but it's just too much risk for an industry that doesn't need that kind of risk. Next he owns Agri Realty. Agri Realty is a new REIT that's been kind of popping up recently, and I always keep it 100. I keep it a buck on this channel. When I don't know what a company really does, I won't speak on it positively or negatively, and I'm not 100% sure what they do. I obviously know that they're a REIT, but I really haven't researched it, so me personally, I'm not going to comment on this one. Next, he owns Lockheed Martin, which has been on a bit of a dip recently. I think definitely long term this will be an amazing company to buy. Obviously, the government has no intentions of spending less on the military over the long term and investing back into ourselves in defense. So I think LMT is an amazing company. Next, he owns Mickey D's, McDonald's, stock ticker MCD, and he's up 14.06% on his McDonald's position. McDonald's is an amazing company in my portfolio. Unfortunately, the only thing bad about it is the valuation that it seems, but with their new Cosmix restaurant, there could be some added value there. I really regret not buying in the 240s when it actually hit there. I was too picky, I was too patient, I was going by my DCF calculators, and I missed out. But still, McDonald's is one of the bigger positions in my portfolio. I own about 3 shares right now, and I'm very happy with that. Next, he owns United Health Group, stock ticker UNH. Now, UNH has been on a bit of a dip recently, too. My issue with UNH is circle of competency once again. There's so many moving parts in that business that I just don't want to move out of my circle of competency. The financials don't lie. It's a behemoth of a company. But also, we've seen with 3M, when you have a behemoth of a company, you have so much, you own literally everything, you're called the everything company, things can go wrong. So I think UNH is a beast of a company. It's a behemoth, but me personally, I'm not touching it just due to the complex nature of their business. Next, he owns Comcast, which recently increased their dividend 7%. This is a bit of a sneaky value play, and I will say I do like this holding a lot. Next, he owns Procter & Gamble. Procter & Gamble is obviously not going anywhere, but I do think there's a bit of a trade-off between that stability there and also total returns, which, I mean, in his circumstances, I don't think there's really anything wrong with. Next, he owns Avgo, which is Broadcom. You get a lot of exposure to Broadcom also in SCHD, so that's plenty of exposure for me, but I think Broadcom is a really solid company. Next, he owns automatic data processing stock ticker ADP, which has been up a little bit recently. ADP is a really strong company. I don't own it. I just don't really understand the nature of their business 100% yet, but definitely one that could be on my watch list pretty soon. Speaking of companies that own everything, next he owns BlackRock, stock ticker BLK. This is an absolute beast of a company as well. Next he owns Aflac. Aflac is an insurance company. Insurance companies are something that I definitely want to look into this year, and it's something that really intrigues me. I definitely do approve of this position too, and Aflac is known as a dividend company. And hey, if you appreciate the Aflac joke, you won't see Dividend Talks doing that. Smash the like button for me, subscribe, and check out the Do Dividend Stocks Not Drugs merchandise. Next he owns Main Street Capital Corp, which is a monthly paying dividend company. Now, I personally don't know a whole lot about this one, so I'm going to stay out of it for now, but I do know that it is popular amongst the dividend investors because it's a monthly company. I just want to reiterate, there's no crazy advantage because a company will pay monthly. There is a tiny effect in the compound interest long term, but nothing really to write home about. So don't fall into that trap as well if you guys are newer and just looking at monthly dividend paying companies. Next, he owns Cisco, stock ticker CSKO, which I think is a decent holding. I definitely think there's a lot better than it, but I think it's a quality holding at the end of the day. It's obviously going to benefit long term from the growth of technology and all that. Next, he owns a company that I've been looking to add to, but it just seems it will never go down, which is, of course, Home Depot, stock ticker HD. I've identified Home Depot, over me personally, as a better company than Lowe's, and it's not because of the crazy growth, it's just more the consistency that Home Depot has had. They have an amazing dividend and share repurchase program. It is something that I definitely want to be into eventually in my portfolio. With that said though, if Home Depot ever gets back near $300 again, I will be looking to buy. Then he owns some healthcare companies in Medtronic, which I don't know much about. Amgen, I think that's a solid holding, but once again, I'd rather have a company maybe like AbbVie in the portfolio, which offers you both dividend yield and dividend growth. It will give you a solid mix if you're looking for like pharma like that. Next, he owns Mondelez, which is basically a candy company and really Hershey's only competitor. Mondelez is a quality company. I'm a little surprised you aren't in like Pepsi, Coke, or Hershey if you're looking for more of a staple company, but I definitely do think Mondelez is solid, and I'm curious to hear your reasoning of owning it over a company like Hershey, which me personally, I think Hershey has a little better brand value than Mondelez and offers a little more value. Then he owns Snap-on, which is definitely an interesting one. It ain't going nowhere, that's for sure. But I do think there are better options. Me personally, industrial-wise, I'd like Caterpillar. Then he owned Best Buy, and Best Buy is one that we talked about in the Cash Flow Kings a little bit. It's a bit of an underrated dividend stock. It's obviously a retail company. So, I mean, Best Buy, it's definitely not one that I'm going to be looking to add to, but it is an interesting one to keep your eye on. We will talk about it on the Cash Flow Kings channel. Next, on the Kinder Morgan Incorporated, which is an energy company. I'll be honest, I don't know much about this one, and the last holding he told me he'd be looking to sell out of soon, it's of course AT&T. And you guys should know by this point my thoughts on AT&T. Used to own it as a core holding, my largest holding back in the day. Eventually opened my eyes up, realized that total returns were a real thing, that my dividends really meant nothing if the stock price would always be going down for the rest of my life. I feel like every earnings report AT&T stock will go down, but it's never because of their stock like actual results when it comes to earnings per share and revenue. It's always just some outside factor. So overall with the portfolio, I think it's a really quality portfolio. I like a lot of the companies in here. What I would personally do, first of all, I would go in all on VYM or SCHD. I'd find one or the other. They're pretty close to the same thing exactly. So I'd find the differences, find what matches your investing strategy best, and then go all in on that when it comes to the dividend ETFs. Then I would build up that food position and have that maybe make up 10-15% of the portfolio. Can't go wrong with that either. And then obviously I think there are a few outliers in here when it comes quality wise, but I would also look at your circle of competency. There's some companies in here that you don't 100% understand whatsoever, and you really don't think that even if you make the effort, you'll be able to 100% understand either. There are just businesses that are naturally like that. I would look at potentially selling, taking some gains, or even just looking at opportunity cost. I think you have room to maybe trim like 4, 5, 6 positions, and you'll be in optimal range, in my opinion. Overall, though, it's a really, really quality portfolio. I want to thank Nick once again for sending in his portfolio. He will be on the Cash Flow Kings live on Saturday, so make sure to be there, 8 p.m. Eastern. Alright, go check out his channel. I will leave it linked in the description. Thank you all so much for watching. If you want to be featured in this, have it over on the Discord link in the description and send me your portfolio from there. Thank you for watching. Check out the Do Dividend Stocks Not Drugs merchandise. Smash the like button, subscribe, and lastly, Do Dividend Stocks Not Drugs, please. Have a good one.